Picture two tax returns sitting on the same accountant's desk. Both show $100,000 in total income. One owes roughly $30,000 in federal taxes. The other owes about $15,000. Same amount of money, same country, same filing deadline. The difference isn't deductions. It isn't fraud. It isn't some offshore trick. It's the type of income. The IRS doesn't treat all dollars equally. A dollar you earned at your desk and a dollar your investments earned while you slept are two completely different things in the eyes of the federal government. The IRS sorts every dollar you make into one of three buckets: earned income, portfolio income, and passive income. Each bucket has its own tax rates, its own rules, and its own obligations. A dollar of salary gets taxed one way, a dollar of dividends gets taxed another. A dollar of rent from a tenant gets taxed a third. Here's the foundation you need before anything else. The federal income tax has 7 brackets, ranging from 10% to 37%, and those rates apply to most forms of income. But there's a second tax system running alongside it that only hits certain types of income. It's called FICA, which stands for the Federal Insurance Contributions Act. That's your Social Security and Medicare taxes. If you've ever looked at your pay stub and wondered why the number you take home is smaller than the number your boss promised, FICA is a big part of the answer. The employee share is 7.65%, split between 6.2% for Social Security and 1.45% for Medicare. Your employer matches it, so the real combined cost is 15.3%. Earned income gets hit by both systems. Portfolio and passive income, in most cases, don't get hit by FICA at all. Earned income is the bucket most people know because it's the one they live in. This is money you get because you showed up. Salary, hourly wages, tips, bonuses, commissions. If your employer sends you a W-2 at the end of the year, that's earned income. It gets taxed at your ordinary income tax rate, somewhere between 10 and 37%, depending on your total taxable income. And on top of that, you pay the 7.65% FICA. If you're a single filer making $90,000, which is close to the average salary for a registered nurse in the United States, your federal income tax lands around $11,400. Your FICA comes to about $6,885. That's over $18,000 in federal taxes before your state even gets involved. Your effective rate, the actual percentage of your paycheck going to the government, is around 20% when you combine both. Self-employment income lives in the same bucket, but the math gets worse. If you're a freelancer, a consultant, an independent contractor, someone who gets a 1099 instead of a W-2, you owe the same ordinary income tax rates. The difference is FICA. There's no employer to split it with. You pay both halves, the full 15.3%, on your net self-employment earnings up to $176,100. Above that, the 12.4% Social Security portion stops, but the 2.9% Medicare piece keeps going with no cap. The IRS does give you 2 breaks here. Your self-employment tax is calculated on 92.35% of your net income, not the full amount. And you can deduct half of what you pay from your gross income. But even with those adjustments, a self-employed person earning the same amount as a W-2 employee takes home noticeably less. Then there's side hustle income. The IRS doesn't have a special category for your weekend pressure washing business or your Etsy shop. If you earned it, it's earned income. And if your net profit crosses $400 in a year, you owe self-employment tax on it. $400. That's the threshold. A lot of people find this out the hard way when they file their first return after picking up freelance work. Quick note before we go further. None of this is financial advice. I'm explaining how the system works, not telling you what to do with your money. Talk to a CPA for that. So earned income goes through both tax systems, the income tax and FICA. That's the heaviest combination in the code. A W-2 employee can't reclassify their wages. A freelancer can adjust some things around the edges, but the income is still earned. still subject to both layers. The only way to fundamentally change the tax math is to change which bucket the income falls into, and that's where the rest of the tax code starts to look very different. Portfolio income is the second bucket. This is money your investments generate: interest, dividends, and capital gains. Same bucket, very different tax treatment depending on the specifics. Interest income is the simplest and the least favorable. The interest your savings account pays you, your CDs, your corporate bonds, your treasury bonds, it's all taxed as ordinary income. There's no special rate. It lands right in your regular bracket, 10 to 37%. Your high-yield savings account earning 5% might sound great until you realize the IRS takes a cut of every penny of that interest at the same rate as your paycheck. There's one major exception. Municipal bonds, the ones issued by state and local governments, pay interest that's exempt from federal income tax. Some are also exempt from state tax if you live in the state that issued them. That muni bond interest also escapes the net investment income tax, which we'll get to shortly. That's why you'll see wealthy investors holding large municipal bond positions, even though the stated yields are lower. The after-tax math often works in their favor. Dividends are where the split starts to matter. The IRS recognizes two kinds: ordinary dividends and qualified dividends. Ordinary dividends get taxed at your regular income rate, just like interest. Qualified dividends get a completely different deal. They're taxed at 0, 15, or 20%, the same preferential rates as long-term capital gains. For a single filer, if your taxable income is under $48,350, the rate on qualified dividends is 0%. To qualify, the dividend has to come from a U.S. corporation or certain foreign companies, and you have to hold the stock for at least 61 days within a 121-day window around the ex-dividend date. That's the cutoff the IRS set. If you buy a stock, collect the dividend, and sell it 2 weeks later, those dividends get taxed at your ordinary rate. Distributions from real estate investment trusts and most master limited partnerships don't qualify either. They're taxed as ordinary income, regardless of how long you've held them. Capital gains are the single biggest line in the tax code when it comes to building wealth. If you sell an asset for more than you paid, you have a gain. How it gets taxed depends entirely on how long you held it. Sell before 1 year and the gain is short-term. It gets taxed at your ordinary income rate, up to 37%. Hold for more than 1 year, sell, and the gain is long-term. It gets taxed at 0, 15, or 20%, depending on your income. For a high earner in the 37% bracket, that's a difference of up to 17 percentage points on the same profit. That spread is why the phrase buy and hold isn't just investment philosophy, it's tax strategy. What's one type of income you didn't know was taxed differently? The third bucket is passive income. This is money generated by assets you own without you materially participating in the work. The IRS defines material participation through a set of tests, the most common being whether you spent more than 500 hours during the year on the activity. If you didn't, the income is generally passive. The two biggest categories here are rental income and income from businesses you invest in but don't actively run. Rental income is taxed as ordinary income on your tax return, same brackets as your paycheck. But the IRS classifies it as a passive activity, and that classification changes the rules around losses. If your rental property loses money on paper, you can only deduct those losses against other passive income, not against your W-2 wages. There's an exception. If you actively participate in managing the rental and your adjusted gross income is under $100,000, you can deduct up to $25,000 in rental losses against your other income. That deduction phases out between $100,000 and $150,000 in adjusted gross income and disappears entirely above that. Here's where rental income gets interesting for people who understand the code. Depreciation. The IRS lets you deduct the cost of a residential rental building over 27 and a half years, even if the property is gaining value on the open market. Say you buy a rental property and the building portion is valued at $275,000. You can deduct $10,000 a year in depreciation, so you might collect $18,000 in rent, pay $12,000 in mortgage interest, insurance, and repairs, pocket $6,000 in real cash flow, but report a $4,000 loss on your tax return because the $10,000 depreciation deduction wiped out the profit, and then some. It's a paper loss on a real gain. Some investors use a technique called cost segregation, where an engineer breaks the property into components, appliances, fixtures, landscaping, and accelerates the depreciation timeline on those pieces. The result can be tens of thousands in deductions in the first few years of ownership. This is one of the main reasons real estate has been a preferred asset class for high-income earners for decades. The rental income flows in, the depreciation offsets it, and the tax bill shrinks or disappears. Royalty income comes from letting someone else use something you own or created. A book you wrote, a patent you hold, a song you recorded, mineral rights on land you own. Most royalty income is taxed as ordinary income and reported on Schedule E. If you're a self-employed creator who's actively producing work, like an author writing new books every year, the IRS may consider that earned income and hit you with self-employment tax on Schedule C. If you wrote one book 10 years ago and the checks keep coming, that's passive income, no FICA. The distinction comes down to material participation, how involved you currently are in the activity generating the royalties. Oil and gas royalties come with their own benefit, a percentage depletion deduction that can shelter up to 15% of gross royalty income from federal tax. That's a deduction with no cash cost to the owner. The oil comes out of the ground, the check shows up, and the IRS lets you write off part of it as if the resource itself were wearing out, even if production is holding steady. Now zoom out and look at both halves together. Earned income faces ordinary rates from 10 to 37%, plus FICA at 7.65% for employees or 15.3% for the self-employed. Long-term capital gains and qualified dividends max out at 20% with no FICA. A W-2 employee in the 22% bracket who also pays 7.65% FICA has an effective combined rate near 30% on their wages. An investor realizing long-term capital gains in the 15% bracket pays 15% with no payroll tax. Same tax code, same filing deadline, different buckets, different bills. There's one more layer. For higher earners, there's the net investment income tax, a 3.8% surtax that applies to investment income when your modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples filing jointly. It hits capital gains, dividends, interest, rental income, royalties. And here's the detail that matters. Those thresholds haven't been adjusted for inflation since they were created in 2013. The tax brackets move up every year to account for rising costs. The NIIT thresholds don't. Every year, more households cross that line without earning a single extra real dollar of purchasing power. Sarah is a registered nurse earning $90,000 a year. Every dollar of that salary is earned income. It goes through both tax systems, ordinary income tax and FICA. Her combined federal effective rate, including payroll taxes, lands around 20%. She has almost no ability to change how her income is classified. Her paycheck is what it is. Now meet James and Linda, a retired couple. They built a portfolio over 30 years. In retirement, they live on $500,000 a year in qualified dividends and long-term capital gains. Married filing jointly, standard deduction of about $31,500. Their first $96,700 in taxable capital gains and dividends is taxed at 0%. The next roughly $372,000 gets taxed at 15%. That's about $55,800 in income tax. They do owe the net investment income tax on the amount their income exceeds $250,000, which adds around $9,500. Their total federal tax bill comes to roughly $65,300 on $500,000. That's an effective rate of about 13%. No FICA at all. Sarah pays 20% on $90,000. James and Linda pay 13% on $500,000. Sarah isn't doing anything wrong. Neither are James and Linda. They're in the same system. The difference is the bucket. This is what Warren Buffett was talking about when he said his effective tax rate was lower than his secretary's. In 2011, Buffett disclosed that he earned $63 million and paid less than $7 million in federal income tax, an effective rate around 11%. His secretary, earning a fraction of that in salary, paid nearly double his rate once you factored in income tax and payroll taxes. Buffett wasn't hiding money. The overwhelming majority of his income came from investments taxed at capital gains rates, not wages taxed at ordinary rates. A freelance consultant earning $200,000 as a sole proprietor pays self-employment tax on the entire net income. That's roughly $28,000 in FICA alone, before $1 of income tax. The same person, same business, elects to be taxed as an S corporation. They pay themselves a reasonable salary of, say, $80,000 and take the remaining $120,000 as a distribution. The salary gets hit with FICA. The distribution doesn't. The self-employment tax savings can be $15,000 or more per year. Same work, same clients, same revenue. Different structure, different bill. The tax code is a set of instructions. It doesn't hide what it does. Every rate, every threshold, every classification is published and accessible. The gap between Sarah's bill and James and Linda's bill isn't a glitch. It's the system working exactly as it was written. Earned income funds Social Security and Medicare through FICA. Investment income doesn't. Long-term capital gains get preferential rates. Short-term gains and wages don't. These aren't loopholes. They're the architecture. Sarah trades hours for income that passes through both tax systems. James and Linda hold assets that generate income passing through one system at preferential rates. Every dollar you earn has a classification. Every classification has a cost. The bill comes the same way regardless of whether you picked that classification on purpose or landed there by default. Knowing which bucket your income falls into won't change what you owe today, but it changes the questions you ask tomorrow. When you look at a new income stream, a side business, an investment, a rental property, the first question isn't how much you'll make. It's how the IRS will classify what you make. That classification determines more about your take-home than your tax bracket does. Those two tax returns from the beginning are still sitting on the accountant's desk. Same income number, different classifications. One passed through two tax systems, the other passed through one, at rates the code specifically made lower. The accountant didn't create that gap. Congress did, and they published every word of it, available to anyone who wants to look. If this changed how you see your paycheck, subscribe.